You applied for finance, got declined, and now you have no idea why. In this video, I'm going to break down how lenders actually assess your application, the most common reasons people get knocked back, and what you can potentially do about it. Guys, if you're new here, my name is Mitch, and I'm an everyday Aussie husband and father with a keen interest in finance and wealth building. I don't claim to be a guru. All I want to do is just share some insight and learnings that will hopefully help you make better financial decisions or teach you something that you're unaware of. First thing, let's take a look at how lenders actually assess your application. It's not just about whether you earn enough and therefore you can afford the loan. Lenders use a scorecard type system when deciding whether to approve a loan. And even if you are a perfect payer with a spotless history, if you do not meet what is called capacity requirements, the lender cannot proceed. Now, it's important to know that when it comes to making a judgment, lenders have to follow something called the National Consumer Credit Protection Act, or NCCP for short. The primary purpose of this is to ensure that lenders do not provide unsuitable loans. So they have to take adequate steps to tick all the necessary boxes before they can approve you. And there are a few key areas that they want to look at. And I want to walk through each of those for you so you actually understand what's going on behind the scenes when they do go to assess your finance application. Generally, they follow something called the 3 C's of credit. Sometimes it's 5, but for the purpose of this video, 3 C's of credit, and we're going to really home in on the first two, which is character and capacity. Now, the first thing I want to go through is your credit file. And the reason for that is I feel it's something that not enough Australians get a full education on. There's not enough information about it. So no one has a real proper understanding of how it works. In simple terms, it's a 5-year running history of your recordable credit activity. For most people, this is the vital part to understand. Every time you make an application for a credit card, a store card, personal loan, car loan, home loan, utility or telco service, or a short-term loan, your credit file gets updated with that inquiry and your score is adjusted accordingly. Now, some of these impact your score more than others, but the reality is that any application involving a full credit check will actually reduce your score initially. It's a necessary part of life, but it is something to take quite seriously. This is why applying here, there, and everywhere is one of the worst things you can do. Every application leaves a mark, and the more marks you have in a short period of time, the worse it actually looks to a lender and the worse it impacts your score. Now, as bad as multiple inquiries are, there's actually something worse that can appear on your credit file, and that is a default or a court judgment. These things effectively mean that you actually owe money to a creditor that you've not paid. A lot of lenders actually take these very seriously, and in a lot of cases, a single default can be the cause for your loan application to be declined. If you know that your credit file has a default already on it, then you need to try and take steps to remedy this, whether it's contacting the creditor, trying to get that all resolved and paid off. If you've got warning that you're about to receive a default, then my suggestion would be to do whatever it is in your power to try and ensure that does not happen. Normally, that is coming to an agreement with whoever you owe the money to. Now, one other thing to be aware of is that if your credit file is relatively new, so whether you're a younger borrower or you're new to the country, then you need to take extra care when it comes to your credit file, as a newer credit file is actually more sensitive to applications and negative outcomes compared to someone who has had a long, clean credit history. And also, guys, one really useful tip is you can actually access your credit file for free through Equifax if you have been declined recently. You're entitled to a free copy, and I will link where you can do that below. It's really easy to do. Just provide a few pieces of your information and they'll send you out a PDF document within about 24 to 48 hours. All right, so the next thing I want to touch on is capacity, and I mentioned it earlier. So essentially what that is your ability to make the loan repayments. And loan serviceability is where your application really gets put under the microscope. And unfortunately, it's actually one of the least understood parts of a lending process. A lot of people will just think, I earn enough money, I can therefore afford the loan. They don't understand that a lot of lenders use a benchmark to assess people, to essentially set a floor as to what their minimum living expenses are going to be. A common one is the household expense measure, or HEM for short. And people are usually genuinely shocked when they find out what these numbers are. So, for an example, a de facto or married couple, you're looking at around $3,000 or more before you even factor in any dependent children to that as a floor for your living expenses. Now, that's just the minimum. A lot of people might even spend a lot more than that. Then, once a lender has that floor, we go and start adding the fixed repayments such as your rent, your mortgage, your loans that you've got, credit cards, they all get factored in. And on the mention of that, a lot of people use credit cards, but they don't actually have the understanding that it is the limit which will actually impact capacity. So having a very high credit limit can actually reduce your ability to borrow. And this is regardless of if you pay it off at the end of every month. So let me give you a rough example using a typical Australian family. So we've got a married couple, living expenses, let's say $3,000 for ease. It's probably a little bit more now, but $3,000. Two children, around $1,000 per month. Then you've got your mortgage repayment, $3,200 per month. A car loan for their family car, $550 per month. Now that alone is $7,750 per month in total commitments before they've even applied for anything new. Now you might think, well, that family is not looking for more debt. But this is actually really relevant right now. Given rising rates and cost of living pressures in Australia, a lot of families are trying to refinance their home loan to get a better deal, and they're finding it much harder to get approved than when they originally took the loan out. The rules haven't changed, but the numbers and the capacity requirements certainly have. The unfortunate thing is there isn't a huge amount you can do to directly influence serviceability, but I think understanding it means you know what your broker or banker actually means when they talk about capacity. So you're not shocked when they do come to you and start discussing these things. So when we talk capacity, obviously it's important to talk employment and income types, as a lot of people, they're just deriving their income from their full-time, permanent part-time or casual work. And I want to focus on casual because casual employment is pretty big, especially in today's workforce, and it matters more than people realize. And I'm not saying that casual employment is bad in any way. All I'm saying is that just be aware that if you are that less than 12 months casual, it's not unusual to be asked for some additional documents or requirements to get things over the line with your loan application. A lot of people will get offered a permanent role, but they're going to stay on the casual rate because they would rather have that higher income every single week. And what they don't understand is when it comes to applying for finance, the higher rate actually ends up getting scaled back down as well. So although they might be earning a certain amount, most lenders will actually scale the net income of that casual person to account for sick days and holiday pay, the things that permanent employees normally would receive and still be paid for. And it doesn't mean you need to change your employment right away, but it's something worth understanding, especially if you are in a situation where you know that you're looking to apply for a home or you're trying to get some sort of large finance approval in the near future, and you are then offered that permanent role, it could be worth considering. Yes, it might be a slight pay drop, but for the purpose of your finance application, it might certainly help get things over the line. And the other big one is self-employed. And self-employed applicants do face their own set of challenges. And I'm not going to go too deep into it. Business lending certainly is a whole another ballgame. But when it comes to self-employed people, when you're doing consumer finance, be prepared to provide your tax returns. Usually, the most recent one is sufficient, but some lenders may actually ask you to provide a couple of years worth just to show that things have been consistent across that. So if you are self-employed, be prepared, speak to your accountant, and just be ready to provide those tax return documents. And a note that aggressive tax minimization may actually work against you when it comes to applying for finance, because dropping your income is going to mean that you then have less capacity to borrow. So it might be worth a few years of paying a little bit of extra tax if you know that a finance application or you're trying to get your first home or your next home, and that is around the corner. So something that might be worth discussing with the accountant when it comes time to do your taxes. Now, what exactly do you do after a decline? So if you have just been declined, I'd say the worst thing you can do is immediately go and apply somewhere else without gaining any further understanding of why your application was actually declined in the first place. Every new application, as I went through earlier, adds another inquiry to your credit file, which makes the situation worse and worse as your score gets less and less. So the first step is to get the reason for decline in writing, whether it be from the lender itself or from the broker, so that you can then go over that and have a great understanding of where you actually went wrong. Lenders are actually required to give this to you, and it will point you in the right direction. From there, it actually depends on what the reason is. If it's a credit file issue, have a look at your credit file, like I discussed earlier, get the Equifax report and see what's on there. Sometimes you might even have an error on there and you realize that it's not actually something that you applied for or something that you did. In fact, that's actually happened to myself. I've had 2 credit applications on my file and someone had somehow gained access to my information through a data leak. And all I had to do was get in touch with the lender that had these fraudulent applications on my file. And they then reported that to Equifax on my behalf. And within about 2 weeks, they were actually removed from my credit file and it was restored back to normal. Now, if it is actually your fault, then unfortunately, there's not a lot you can do about that other than contact the creditor and get it resolved. Once you've got it paid off, get the proof of payment. That will then help you with any future applications. Yes, you're still going to have to explain yourself and it's probably still going to impact things, but it's better than an unpaid default. Eventually, in time, that will drop off your credit file. If the reason for decline is serviceability, then you do have a few levers that you can pull. Obviously, if you've got any existing debt that you're able to close, then you can look at doing that. If you've got unused credit cards, you can close them or bring the limit down. The other thing I'd strongly recommend is, if you can, find a good mortgage broker or finance broker to try and assist. Now, oftentimes, yes, you may have to pay a little bit more with a broker as they might have a fee involved. But if you do have a more complex situation, then they're going to try and find the best possible solution for you. And a mortgage broker, I mean, you don't have to pay them anything. Essentially, they get paid by the bank and they're going into bat for you to try and find you the right bank to benefit you in your situation and try and help you get the approval over the line. So always good to have someone in your corner who's there working for you. So to wrap it up, lenders are looking at your credit file, your capacity to repay, your employment situation, all of these things all at once. There's quite a few other things that do come into it as well, which are a little more complex, but understanding these main 3 before you apply puts you in a much stronger position. Guys, if this video did help in any way, I'd just ask that you hit the like button and subscribe to the channel. I'm going to do plenty of videos that might help to give you further education on topics in the future. Drop a comment below if you've got any questions and I'll do my best to get back to you. And if you do want to keep building your knowledge, check out some of my other videos. I've done some on home loans and novated leasing. But otherwise, if you've made it this far, thank you for watching and I will see you in the next one.